The answer about money. We are talking about money today. We have so much to cover. Been strange markets, a strange time, 2022, but it reminds me of another time, the time of October 19th, 1987. There's not very many people who were around and doing business in 1987 who are still around in 2022. But October 1987 resembled or seemed to resemble what was going on in 2022. And people had very short memories. October 19th, 1987, the market plunged 30% in one day. And the pundits and the gurus came out announcing their analysis. And everybody, or most people, thought there was going to be a recession. That was the general consensus. The Fed was raising interest rates. The market had plunged down, and it had plunged down a whole lot in a very short period of time. The market was the predictor, of course, that it was going to be a recession. And in fact, I don't remember who said it, but I heard it, that there was going to be blood running in the streets. There was a wholesaler that came in and said things were so bad $1 trillion was gone out of the economy, you'd be able to walk into Nordstrom's and hear a pin drop. So much wealth had been wiped out. You could go into Nordstrom's, and remember, this is October. This is Christmas shopping time. So much wealth was gone from the economy, you could walk into Nordstrom and it would be so empty you could hear a pin drop. That was the prediction. I started counting how many people predicted that the market would rally and go up compared to those who thought it was going to go down further, and how many thought it was going to stabilize and not rise at all. And when I got to 65 to 0, I stopped counting. It was bad news. People were terrified. So much fear. And all those gurus, all those pundits, all those experts about the market, not one of them got it right. Not one. They didn't get it right as to why the market dropped down, nor did they get it right as to what was going to happen afterwards. And I wonder if that isn't a lot of the situation that happened in 2022. But first, let me give you the recap of what happened. I licensed in June of 1986. So I'd been in the business. I was a newbie. I was just a little over a year in the business. And for me, it was a time in which I didn't have the experience. I hadn't been around that long. I was a newbie in the market. I was still in a bullpen. I was dialing for dollars. I was dialing every day trying to reach 10 or 15 or 20 people to talk to, hoping to open 10 accounts a month, and I'd been doing that pretty well up until that day in October of 1987. Now, the previous Friday, the market had dropped to 108 points. Think about it in this way. The market had dropped down almost 1,000 points on the previous Friday. Coming in on Monday, I turned on my Quotron machine, which we didn't have computers in those days. We had Quotron machines, which gave you all the quotes. And as I turned it on and prepared to call, the market continued to plunge down. The market had been at 2246. Compare that to today's 32,000. The 30,000 some odd. And the market began to plunge down on that Monday. It continued down just as it had on Friday. In the first half hour, the market dropped another 100 points. It was like the market opening and falling off 1,000 points today. The market fell down. I was so mesmerized by what was happening that I didn't even make any calls. I just sat there and watched the screen. Now, PaineWebber, I worked at PaineWebber at the time, now UBS. PaineWebber had launched a program about 6 months or 8 months before, trying to market what was going on and convincing people to do covered call writing. Covered calls, right? Buy the stock, sell the call against the stock, and make a little extra. So, for example, I bought Chrysler. I bought into what PaineWebber was saying, and I bought Chrysler stock, $52 a share, sold the $55 call, so got an extra $2.50 from the premium for the call. And as I sat there that Monday, I watched, well, you know the way it works. When you buy a covered call, you hope if the stock gets called away at 55, you actually made the call, the price of the stock, that small increase, plus you made the premium from the call. And now you can buy another stock and write the call against that. And if the stock doesn't get called away, you make an extra $2.50 or whatever the call was sold for. And that becomes extra income. And you can do it for conservative clients, they told us. And now get this. This is where we're sitting on October 19th, just as we sat every day in the bullpen. And there's a squawk box. There's a box with information coming in from experts throughout PaineWebber and some even beyond PaineWebber. They're talking about what's going on in the New York Stock Exchange. You have the market strategists talking to you, all that building up. They analyzed what happened on Friday. They tell you as the market drops 1,000 points in today's terms, that the market is beginning to look like it might be a little bit of a correction. Might be. The market now, we're just half an hour into the day, and the market is down over 100 points, 1,000 points in today's terms. And then it began to level out. And the squawk box is going and saying, maybe this is over with. The squawk box is going this whole time, telling you just what to do. And, well, it began to look like it might level out. It began to drift some. And in the next half hour, the second half hour of the day, it dropped half as much, maybe 50 points, somewhere in that neighborhood. It dropped. So now you're down about 1,500 points in today's terms. And I'm sitting there watching as the first hour finishes and the market begins to drop again. And this time it drops more than it dropped in the first half hour. It drops maybe, in today's terms, 1,100 points. We're now down 2,600 or 27 in today's terms. In those terms, 250 points. And I'm sitting in shock. I've been watching this whole thing for an hour and a half and watching it come down. And it's approaching probably closer. It's a good, in today's terms, 3,000 points. It's come down. And then it stops going down. And it begins to rise. And the squawk box is getting strangely silent. But the stock market's beginning to rise, and in the next 15 minutes, the market raises up about 50 points. It looks like there's a rally going on, and you go from minus 3,000 to minus 2,500, and you begin to think things are going to be okay. It's beginning to look like a reversal. Even some people are talking about a reversal until the next hour. It loses all the gains. And it takes an hour to get there. So, when you're looking at it, it's down 3,000 points. But once again, it begins to get even. It reverses, and it goes up 20 or 30 points. 300 points maybe in today's terms. And then it reverses, and it really begins to drop. Because it drops a lot. It drops down. Now it's minus 4,000 or 4,500. And the hopes begin to walk away. It's 11:30 Pacific Hour Time with an hour and a half to go. I have not done a single thing as I'm sitting there watching this whole thing. And in the last hour and a half, the market doesn't turn around. It continues to sink. Another 260 points. Down almost 8,000 points. Over 8,000 points. In today's terms. Think about it. Think about watching this It had already dropped 1,000 points on Friday. Now it drops another 8 to 10,000 points on Monday, all in one day. And now on Tuesday, while I sat there and watched the whole thing go down, I watched my Chrysler stock at 52 with the $55 call. I watched the stock go from 52 to 12. And I learned something that day. I learned that when you write a covered call, you limit your upside and you accept the full downside. From that day forward, I decided I'm only going to do stocks that have twice the upside as downside risk. That served me well over the next 35 years. We're coming to a commercial break. I want to come back and talk about what the experts had to say about that, because you'll find something very similar to what they were saying in 2022. Don't go away. We'll be right back after this commercial break. Stay with me. So I spent the last section I talked about and gave you a blow-by-blow description of what happened on October 19th, 1987. But what's really important to understand is the analysis that went on. Because the next day, you had market strategists, you had people talking about why this happened. What were investors to do? All the pundits, all the gurus, not one said, I don't understand what happened. That is something that baffled me as much as I've been around. I don't understand. Instead, they began to talk about why it had happened, in their opinion. And every single one was wrong. Every single one that was talking was wrong. No one ever admitted that they just didn't know. I had a client, actually, who was in his 80s, who, without the technical expertise, he actually figured it out. And I'll tell you more about him later. But right now, let me come back to the experts. They said that the Fed was raising interest rates, which they were doing. And that was pushing us toward a recession or even a Great Depression. So bad that blood was going to run in the streets. And I don't remember who said that. I remember it was a mutual fund wholesaler who said that you'd be able to walk into Nordstrom and hear a pin drop. It was going to be so bad. They said the Fed was raising rates. We were headed for a recession. No question. No issues. We were headed for a recession. They said that we had a bull market. It started in 1979 or 1982, either one. We had this long bull market. We'd seen the market grow fivefold if you took 79 and 2.5-fold since 82. And so the market was already old. The bull market was already old, and it was time for a correction or even a bear market. And a lot of people were predicting a bear market. Stock market was telling us this, you know? The stock market was telling us this. It was telling us this. It was saying that stocks were overpriced. It had this great bull market, and stocks were overpriced, and so they needed to come down. They just gave us all these reasons why, just as they did in 2022. They knew. No one said, I don't understand. But what really happened? What really happened was computer trading had begun. Different in those days, different in 1987. Didn't have computer algorithms written to actually do the trades. Instead of having computer algorithms, computers were developed and programs were being written for what was called portfolio insurance. They were grouping buckets of $25 million of stock, and they said if the market is going to begin to fall, to protect their gains, they're going to press a button and sell $25 million worth of stock. It all sounded wonderful, all sounded good. They had criteria set up. The computer could analyze everything. Computer could send out a signal. And you had the brokers or the traders who could simply push a button and sell $25 million worth of stock, or they could push a button and buy $25 million of stock. Push one button, you sell. Push another button, you buy. It was all set up to make sure that you didn't lose money in the market. That was the way it was supposed to work. Only as the market took its big drops and the shares traded, the playbacks coming to the brokers who were running those computer programs, instead of getting returns and seeing that their trades had been executed as would be normal, there was so much volume going on, the playbacks, the returns were not coming back. And the traders began to think, my trades didn't execute, so I'll press the button again. So intending to sell 25 million, they sold 25 and then another 25. And when that playback didn't come, they pressed it again and sold another 25. And this wasn't just one trader. This was a multiple number of traders that are pushing a button to sell $25 million worth of stock. Didn't matter about the fundamentals, didn't matter about the momentum, didn't matter about any of that. It was just simply set up to sell a basket full of stocks to protect. Didn't care about support levels, didn't care about what was going on in the market. Now, you wait 10 minutes, you don't get a feedback, you've just decided that your trade didn't go through for whatever reason, so you're gonna trade again. And that happened hour after hour after hour after hour. And so it was there. That's why it all came apart. It wasn't because the Fed was raising interest rates. It wasn't because we were headed for a recession. It wasn't because stocks were overpriced. Some were, some may have been. It wasn't that it was uneven. It wasn't that the market had gone from 790 to almost 3,000 or 2,500, and the bull market was coming to an end. It wasn't because the bull market had been extended for a long period of time and had not had a correction during that period of time. It wasn't for any of those reasons. It was because you had traders who were pushing the button, and when they didn't get their feedback, they pushed the button again. And when they didn't get the feedback, they pushed the button again. And when they didn't get the feedback, they pushed the button again. Nothing having to do. All about hedging, all about unproven technology. That's the kind of instruction which is important to understand for 2022. It's not overpriced stocks. It's not market psychology. It's not a pin dropping because wealth has been wiped out. By the way, I told my wife when I heard that on Tuesday, October 20th, this weekend we have to go to Nordstrom's because a wholesaler has said you can walk into Nordstrom's, so much wealth has been wiped out that you'll be able to hear a pin drop. The store's so empty. We went to Nordstrom that Saturday. We could hardly get into the store. It was so crowded. I kept saying to her, somebody must not have told these people that they lost $1 trillion in wealth. You know, that's where we were. And not only that, all those people that predicted we were going to be in a recession or a depression, all those people who predicted that were absolutely wrong. The market didn't die. In fact, it began to recover, and within 90 days it recovered about half of what had been lost, and in another 7 or 8 months there were new highs in the market. Surprise, surprise. That was not the way it's supposed to be. That was not, according to the experts, what was going to happen. When I see the predictions in times like 2022 or in 2020 or in 2008 and see the experts predicting, and not just the experts in the market, But economists, remember, economists in 2008 and 9 were saying people were out of work so long, over 6 months, they were losing their skill level, and we could only count on unemployment being 7% per year. That was going to be the best we could have. Unemployment numbers of 7%. We got down to 3%. You know, we hear the comparisons and the fear and the analysis making things sound as bad in 2022 as they were in 2008. You know, there's a difference. 2008, there was 10% unemployment. People were losing their houses. People were fearful for their jobs. Look around you and your neighbors were out of work. They were drawing unemployment. It was a very tough time, not like 2022. And so there's lessons to be learned from these periods of time. I take you back to 1987 because it seemed to be such an almost parallel analysis of what was going on. I said that one of my clients had diagnosed what was wrong. And I have to say, he was 80 years old. He'd been investing in stocks for a long time. He said simply that the stock market got overpowered by technology. The stock market got overpowered by technology. He had actually been a stockbroker in 1929, and he remembered in 1929 what happened was that the number of trades that went through, the number of trades was so gigantic compared to what had happened before that the exchanges had to rent every hotel room in the city of Seattle to lay out the paper to try to match the orders and the trades. He talked about that. It was just simply the volume overwhelmed the market. 1987, he said the volume overwhelmed the market. 2022, I wonder, as we look back on that, if we didn't see the same kind of things happening with the market. Now, that client I want to tell you more about because he was on margin. He was on margin. 80 years old. I put off calling him. I knew I had to call him. He wanted the trade on margin. And I thought as the market came down so much and he had margin calls, as he had margin calls, I thought, how could I let an 80-year-old person do margin? You know, he had an interesting response. I didn't know if he was going to cry, if he was going to yell at me, what he was going to do. But his response was really interesting. Stick around and I'll tell you about it.
.com.
So I told you, I started the program talking about 1987 and the market plunging down. And I told you that I had a client that figured out what happened. But that was later in the story that I would find that out. That was later in the day. On Tuesday, the margin call notices went out saying that people had margin calls. And this is a client. I was new in the business. And this was a person that I was a stock jockey. I was buying and selling stocks. I was cold calling. I had called this person, this guy, and he opened an account. And he was in his 80s. And he said he wanted to do margin. And he seemed pretty aggressive. He was old. He wanted, most people 80 years old want to protect their capital, don't want to take a lot of risk. But he said he had sufficient net worth, and he did, multi-millions according to what he said. Said he'd had a lot of experience in the stock market. He wasn't worried about the margin. And so he was on margin. And he was one of my early clients. He'd been a client for 6 or 8 months. I'd sold him a couple stocks, did a couple trades, and everything seemed to be working well. And then came Friday, October 16th, and then Monday, October 19th. And now he had margin calls. And I had a couple other people on margin. So I called them. I put it off until almost the end of the day. I knew I had to call him. I knew I had to tell him, you've got a margin call. You need to put in more cash. But I didn't know how I'd respond. 80 years old, he could have told me, you're such a stupid idiot. How could you put me at 80 years of age into margin? He could have screamed at me. He could have cried. He could have done any number of things. But when I called, I was really shocked. His response was that he started to laugh. And he had kind of a high-pitched voice. And he came back and he said, I was on margin in 1929. I was on margin in 1931. I was on margin in 1937. I'll tell you something, he said. 1931 to 1937, percentage-wise, was the best market of my lifetime. That really shocked me, because all I'd heard about is people losing their money in the stock market in the 1930s, in the Great Depression. People being wiped out. People seeing their fortunes gone because of the stock market in the Great Depression. And here he's telling me from 1931 to 1937 was the best stock market he'd ever experienced. After the phone call, I went and I looked it up, and it was an extraordinary recovery from 1931 lows. It was a great market until 1937. He said that he'd been in the stock market for over 50 years. And we ended up talking for a couple hours, talked until maybe it was 2 or 3 hours, talked for a long time. Said that he'd been on margin in 29, 31, 37, in the 40s, in the 50s, in the 60s. Talked about all those times. And he says, we talked about how do you handle a margin account? How do you deal with it? And what I'd been told is you needed to call clients and tell them they needed to send in more money. And what he told me instead was, when you have a margin call, you sell to meet the margin call. He said you sell because you need to play another day. And, I've learned lessons. There's more to it than that. But it all goes through. And we spent those hours talking about the market. We talked about some of his training as well. When he was in 1929, he was a stockbroker. And his training consisted of taking the ticker tape and writing stock prices on a blackboard. That's what he had done. Talked about my training. We talked about his training. We talked about 1929, and we talked about 1987. And he said, if you look at what happened in 1929, the selling overwhelmed the market. It just absolutely overwhelmed what was going on. No one knew what the trades were going off at. They were just going off. And he said some things that made some sense. He said, people don't panic buy. You never get into a panic. You gotta buy, you gotta buy, you gotta buy. But people panic when they sell. They buy, they see the stock go down, then they buy maybe some more, and it goes down, and then it goes down, and then it goes down, and then they panic, and they sell. And he said that was 29. People just panicked. They saw the market going down, and they had to get their orders in. There was a rush. Everybody was rushing in to get their orders. If they had a lunch break, they were rushing into the brokerage office to put in their orders, to send on the teletype back to the New York Stock Exchange and sell it, to the American Exchange, or Seattle actually had a Seattle Stock Exchange. The idea was you had to sell. It was just absolute fear. Couldn't wait until tomorrow. Couldn't wait until next week. You knew that if you waited, you were going to be wiped out. And so even the best stocks were down 30 and 40%. And it happened. It hadn't happened just on October 29th, 1929. It had been happening before. But you know what? What he said is that you have to sell to meet margin calls, but to panic and sell is the way to wipe out your fortune. He said, most people can't sleep at nights because if the market is going down, 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 they think that it's going to go to zero. He didn't say to me, but another client once said to me, when you've got a market that's going down, if stocks go to zero, it doesn't matter. It doesn't matter what your stock portfolio is worth. The country's in bad shape if all the companies go broke. Said, just relax, let things happen. Things will get better. And it really does. Over the years, I've learned that advice from that client has really worked. It's helped me through a lot of client accounts. It's helped me manage money. We talked about the differences in stocks and the differences in technology and the changes that were going on in the stock market. We talked about the similarities between the Great Depression and the time leading up to the Great Depression. And we talked about the 1980s and what was going on then and what was happening on October 19th, 1987. Overwhelmed. When you think about 2022, you think about computers doing 65% of the trades. 65% of the trades are now done by computers. And computers don't have logic. They have an immense capacity to examine data. But think about it. It's always backward looking. So if a computer is observing a person flipping a coin and it comes down heads, and even you, if you look at somebody and they flip a coin, it comes down heads. They flip the coin, it comes down heads. They flip the coin, it comes down heads. They flip the coin, it comes down heads. They flip a coin, it comes down heads. They flip a coin, it comes down heads. What would be your prediction of the next flip happening? What's your prediction? Think it's going to be heads? Computers have seen 100% of the time when the coin is flipped, it comes down heads. 100% of the time, the coin comes down heads. What do you think the computer's projection is going to be for the next flip? Think it's going to be 50-50? No, I think it's going to be close to 100%. Maybe 98%, 97%, allowing that there might be some error. But the computer looking at that pattern is going to project that pattern forward. In fact, even us as humans, when we see patterns like that, we begin to project it forward. You see that analysis made by market pundits, by market gurus. You see them looking at patterns in stocks. John Train wrote a book called The Money Masters, in which he offered $10,000 for anyone who could predict the movement of a stock based on the first. He would give them a chart of a stock, give them the first half. If they could predict the second half, he would give them $10,000. They didn't have to pay anything for that. All they had to do was predict where the stock was going to move. He never had any takers because humans recognize there may be a pattern, but the pattern can't be projected forward to be continued. Flip the coin 6 times in a row and get heads. That's going to happen once out of every 64 times. Now, if you have 1,000,000 flips of the coin, you'll get to 50-50. But with a small number, you don't get there. 2022, with the computers analyzing data, they've never had data on a pandemic. They've never had data on the recovery from a pandemic. They've had information on the Fed raising rates. They've had information on long-term bull markets. They've had information on growth stocks. Is that how they came to the projection that they needed to sell? Is that how they analyzed the data? I think so. That's my guess. We're coming to a commercial break. Don't go away. I want to finish this off with this whole idea of what's happening. So I started talking about 1987 and the pundits and the gurus and the experts, how they misanalyzed what was going on. They saw the market plunge a little bit on Friday. They saw it plunge on Monday. you can put it in perspective by seeing in today's market on the Friday before the Black Monday dropping 1,000 points, on Black Monday dropping 10,000 points. Huge drop. You can see that the experts pressed to give an answer, didn't say, I don't know. Baffles me. They didn't say that at all. They said, the Fed is raising interest rates. We've been in a bull market for a long time. Stocks are overpriced. A correction is due. Maybe we're entering a bear market. We're entering a time of a recession. The chances of a recession are really great. Could be a depression. Those were the answers back in 1987. 1987. Think about it. Think about what was going on. There's not many people that have been around long enough and been in this business that long to remember those times. You know, that was 35 years ago. 36 years ago. It's been a long time since that happened. And not very many people try to put together what happened then and what happened now. But I'm doing it for you. I hope you understand. I hope you heard the first part of the program because I took you through an hour by hour, half hour by half hour, blow by blow description of what happened in 1987. What happened in 1987 was portfolio insurance, was computers and portfolio insurance. And when the market got overwhelmed with volume, the brokers and the traders who had the computers available and the ability to sell $25 million of stock with a press of a button were doing that. They were exactly doing that. 2022, 65% of the trades are going off with stocks. And the computers looking and analyzing past data. Fed is raising interest rates. Think about the last time the Fed raised interest rates. 1998-99. Think about what stocks were soaring at that time. They were the internet stocks. They were the growth stocks. They were the stocks that had significant gains. Stock prices were up, or the market was up 40%, over 40% in 99, and had been up way up in 98. Now the Fed raises interest rates. And what happens? The stocks come crashing down. They come crashing down. And think about it. Stocks like Exodus Communications, which had soared, which had built itself to a $32 billion market cap. Exodus Communications. They had almost no revenues. They had no earnings. They were losing a ton of money. The only way they continued to go forward was to sell capital stock. And companies grow three ways. They either earn it. Exodus had no money they were not earning it. They borrow it. They issue bonds or they borrow it from the bank. They didn't have any credit quality to do that. Or they issue capital stock, and that's what they were doing. They were issuing capital stock every so often, and people were buying it because it was a .com, and .coms, of course, they were going to be marvelous. And in fact, that was a true prediction. We know with the internet that did happen, but it was early in the game. These companies were still no revenues, no earnings. They were bleeding cash. That's where we were in 99. And so when you're looking at a pattern, if you're a computer looking at a pattern without the logic to think about the full extent of what's going on, you look at 2020, 2021, and you see the market going up. And now the Fed is raising interest rates just like they did in 98, 99. And you see the Fed wanting to slow down the economy. You see, just like 1999, you see the stocks, the growth stocks, have had a tremendous run, and you've had a long, long bull market. By 99, the bull market had lasted for 30 years, 20 years, 79 to 99, 20 years, you had a bull market. In 2022, you've got a bull market that's lasted 13 years. Long time. Long time. The bull market's getting old in the tooth, you could say, if you're a computer, if you're a guru. It's been around a long time, and you've seen stocks double and triple and quadruple in value during that period of time, and some even on a shorter period of time. And you're seeing things happen. Stocks are moving and growing faster. Their revenues are growing much faster. Their earnings are growing faster. And you're seeing companies with fairly good price earnings ratios. And the Fed is raising rates. And so what's going to happen? Things are going to maybe slow down. And during the pandemic, some of these stocks were really roaring along because of living conditions changing, work conditions changing, buying patterns changed, technology was changing, lifestyles were changing, demographics were changing. All of that was going on, and some of these stocks were soaring, and some were beginning to see growth slow down. But the reality was, in 2022, these companies were seeing record revenues, record profits, record cash levels, and record levels of raising cash. Completely different from the dot-com time. The dot-coms were, many didn't have revenues. Many didn't have any profits. Many were burning cash instead of creating cash. Very different time. But when you look at it, the Fed was raising rates then. The Fed is raising rates now, or was raising rates in 2022. In 1999, you had a long bull market going on. 2022, you've got a long bull market going on. 1999, you have a lot of growth stocks and that have achieved double, triple, quadrupled their value. In 2022, you have stocks that have doubled, tripled, or quadrupled in value, and some faster than anyone ever expected. There's a lot of parallels. And if you're a computer, a computer and you're looking at someone flip that coin, heads, 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 heads. The analysis is the chances are the next flip's going to come up heads. You don't think 50-50. Don't think a flip is going to be a 50 chance of a tail. You think it's going to be heads. That's the way the computer analyzes. And yes, I'm oversimplifying to some extent. But as we look back into 2022, is that not going to be a lot of what we see? I think so. Anyway, I will admit I don't know. I'm not like most of the experts and gurus who have the definitive answer. I could be wrong, but I would guess that's a lot of what we've seen in 2022. And with that, have a very good week, a very good weekend. And if it's Saturday, we'll be back to be talking about money. And that will wrap up 1987, 2022. Similarities, yes. The same exactly? No. But lessons to be learned, just the same.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590.